I'm back with another case study to show you where you should be saving your money if you want to retire early. So if you're in your late 40s, early 50s, even late 50s, going, look, I want to retire at some point. Don't know exactly when, but I don't know where I should be saving. Should it go to my 401k, my IRA, a Roth IRA? But do I make too much money for that? But what about a brokerage account? That's what I'm going to show you today. Now, it's important to know, and this is my pet peeve. Some people's pet peeve is, hey, people that drive slow in the right lane. Some people are like, no, that doesn't bother me. To me, the biggest thing that bothers me is when people say, I think I could get away with spending $6,000 a month, or I could get away with spending $7,000 a month. I think my retirement could still be okay. Retirement is not about getting away with anything. Retirement is about saying, how much would you love to spend? And I will be the first person to say, why on earth are you working? Because you told me you did not want to die with $10 million. And I'll be the next person to say, look, if you want to spend $15,000 a month, great. Here's how much longer I want you to work so you don't run the risk of running out. So I'll joke and say I'm the meanest financial advisor because I just don't want you to run out of money, and I don't want you mad at me when you're 80 with plenty of money. There's a balance there. That's what I'm going to show you today. Now, my name is Taublieb. I'm a certified financial planner. I'm the host of the Early Retirement Podcast, and I'm the vice president here at Root. Now, if you're looking for guidance on healthcare and tax and withdrawal and estate and insurance, and that's what we do. We do holistic financial planning, not just you need to rebalance and invest well. Yes, that's important. Yes, we do all those things, but it doesn't go deep enough. So today we're going to take a step back and understand, where should we be saving? Really asking yourself, where should your next dollar go? So you can see now we're right inside. This is a real couple. This is the real software I use for clients. So if you guys want access to everything I'm about to show you today, you can see it in the description of this episode. You can play around with the same software and the same tools. So this is the couple. They're 48 and 49. They've got $10,000 in their checking account, a home worth $700,000, and a mortgage. Spouse has an IRA, they have a 401k and an IRA. So it's all pre-tax money, and they've got some life insurance going on. So pretty simple situation. What they're wondering, and when I first discussed with them, I said, hey, guys, when would you like to retire? And they're like, well, we don't know exactly, but what if we just say 55? I said, okay, well, we've got a plan for healthcare. Now, healthcare, I'll be very conservative. Now, this is saying $6,000 a year each for them until 65. So from 55 to 65, in reality, it could be a lot less. And I'm going to show you that today. Now, in terms of their expenses, they said we'd love to spend $8,000 a month after taxes adjusted for inflation. So about $100,000 a year, some home improvements and other things that they want to do as well. But I said, hey guys, does that include all the travel and everything like that they want to do? And they go, it really does. I'm like, okay. But some of you guys are like, no, we want to plan for all of that stuff and more. And if that's you, you want to go in here and go, yep, we want to help out with buy a car every 10 years in a wedding, and we want to do vacations. And what if we buy this other property? And all of this stuff, you want to include your pension and distributions and inheritance. All of this can be included. I'm just showing you a simple version of this. So this couple came to me. Here's where they are, 48 years old. They're making money, doing well. At 55, they go, could we stop working? And you could see they could do it. They could be okay. Now, they don't have a child, so they're like, look, we don't want to die with millions of dollars. That's not our goal. We want to be strategic, and we don't want to work longer than we need to. But they came to me at first, and they said, I think we're in a good spot, but we don't really know. And I said, okay, well, right now you're saving 5% to your 401k and another 3% to your spouse's 401k. What if you guys stopped that? And they're like, why would we stop that? I go, just humor me for a second. And they go, well, that makes a pretty big difference. Like, adding to my 401k is really helpful. And they said, okay, this is a good reminder for us to see why we do this. Because when 401ks are on autopilot, all of a sudden you're like, hey, well, I know I'm adding money to retirement, but like, am I going to actually ever use that? Is it real? And this allowed them to get a nice reminder. So that's why I do it. Now they're like, okay, we don't want to run out. And I said, I'm cool with this 5%, 3%, no problem there. So let's refresh that and put it back on. But if you want to be really strategic and do the next level of planning, and that's why they came to me, they're like, hey, I know you can be strategic about healthcare and tax stuff, but like, what am I missing? And I said, in your case, you don't have a brokerage account, that superhero account. So I said, I want you to just add $1,000 a month to that. That'd be $12,000 a year. Look at the impact that has on their plan. And they were like, okay, so it helps. It's not like night and day, but you want us to add $1,000 a month? Okay, so there's $200,000 more dollars at the end. And I said, do you think you could save more? They go, yeah, right now, work is kind of crazy, but we're not traveling. And so because of that, we probably could. I said, could you maybe save $2,500 a month? And they're like, look, that's kind of pushing it. Like we could, but we don't want to completely take away our lifestyle today. I go, I don't want you to either. What do you think you could do? And they're like, well, this is a big difference. I mean, this is very clear. If we save more, we make more money. And I said, no, you're missing the point here. And they're like, what do you mean? I go, well, when you retire and you're 55, you can absolutely use something called the rule of 55, which means when you take money from your 401k, you can say, as long as you retire in the year you turn 55 or later from that company, you can take money from that. You still have to pay taxes. It's like any normal 401k, but you don't have to pay the 10% penalty because it's coming from a 401k. If this couple retired at 54 instead of 55, well, now we're going to have a big problem because they have no other way to create income unless they want to pay taxes and the penalty, which I promise you do not want to do. I told them the earliest that they could retire comfortably is actually by stopping 401k contributions. And they're like, what? Why would I stop? And I said, well, in your situation, you're actually saving too much towards tax deferred accounts. And they're like, wait, give me an example. I said, okay. So my parents, they are what's known as house rich, cash poor. A lot of you have heard of this before, where someone's got a significant net worth like my parents, but their house doesn't pay the bills. Net worth isn't cash flow. So they have a lot of net worth, but that's not going to help pay the bills, which I know I just said, but the example here I'm given is very simple, which is they don't have investments to create income. So yes, they have a home, but house rich, cash poor doesn't help you out. This couple right here is qualified rich, cash poor. I made it up. It doesn't exist. But the point here is they are so heavy in tax deferred money that they don't have any actual way to create income if they want to retire early, and they don't have a strategy to keep their income low for healthcare purposes. So an example I'm showing you right now, and all of this is available, is if they want to have $100,000 a year in retirement, and it's two of them, and they're 55 and 56, and they actually don't have any children, what healthcare costs might look like for them is about, you can see they'd receive $1,000 a month. That's a federal subsidy, a premium tax credit, and they would be spending $700 a month. So they would be spending $700 a month. And so right there, that's $8,400 that they would be spending a year, not $6,000, but $8,400. So we might have to increase that, you can see here, to $8,400. Now, it's dependent on your zip code and a lot of other factors here, but that makes a big difference. And so when people are worried about healthcare costs, there's a reason they're worried. This is why. It's what if it costs more than we think and we need it from now all the way until we turn 65. But now let's use my example. Let's assume I said, hey guys, don't add as much to your 401k. I actually want you to just get the employer match, which for them is just 3%. And then I want them to be able to save $3,000 a month. And they're like, look, it's going to be tight, but I think maybe we could do it. And I said, okay, well, let's assume you did do it. And right now, it looks like you're barely making it. I mean, $13,000 left over. But let's assume because you did a good job and you listened and you saved to your brokerage account, when you retire early, you don't have to pull from your IRA. You can pull from your brokerage account. Well, your brokerage account, that's after-tax money. So now, if they have, let's just call it $300,000, and they want to pay for health care, $100,000, that's not their income because they saved $300,000. It grew to maybe $400,000. They're going to have dividends and interest, but their income might be $30,000. It might be $40,000. What if it's $40,000? Let's just hypothetical, $40,000. Well, now what's happening is they're spending $1,600 a month. They are receiving a benefit of $1,600 a month from the government as a premium tax credit. They're spending $70 a month. So now they're spending $70 a month or $840 a year, not $8,400, $840, and watch what happens to the plan. And this is what planning looks like. All I did is say, hey guys, I need you to save a little bit more outside of your 401ks, And they got so excited. They're like, hey, we have enough there. Like, we don't want to give up free money, but like, we're not adding any more money to our 401ks after this, because now I see if I add to my brokerage account, all of a sudden that keeps my healthcare costs really low. And look what we're on track for. And I said, guys, you told me you didn't want to die with $5.3 million. And they're like, we don't. I go, what about retiring earlier? What about 54? What happens there? It's a big impact, don't get me wrong, and they saw this too. They go, okay, but it's still $2.5 million, and I just realized that I got another year of my life back, and I was strategic about healthcare. So you want to make sure you're connecting all of the dots in terms of where you're saving. So more often than not, people come to me and they're just adding new money to their 401k or IRA or a Roth IRA. That's great. To me, the Roth IRA, amazing account. If you're under the income threshold, then you get to do that. And I'm going to show it to you guys just as a reminder. I misspelled this. So important numbers. I got all my fancy sheets here. You can see for you guys today, here's the phase out, which means if you're single and you make over $161,000, you cannot do the Roth IRA. If you're married and make over $240,000, you cannot add to your Roth IRA. So based on their income, you can see here, $115,000, $85,000. Well, they're also doing 401k deductions. So we can do Roth IRA contributions. We can no longer add unnecessary money to your 401k. There are odd instances, not often, where I'll say, hey, like, give away the employer match because you're going to make way more money just doing this brokerage account because it's going to save you on healthcare. Other times, and I'd say 90% of the time, it makes sense. Get the free money. There's no reason not to. It's just rare if someone's retiring in a year or 2 years or something like that, and they have nothing in a brokerage account. So this is the type of planning that we're doing with clients when they want to save and invest. So if you want access to this tool, awesome. That's what it's here for. It allows you to connect all of the dots to your tax, to your withdrawal, to your estate. This is real planning. And so I want to make sure all of you guys, our philosophy here is don't pay more than you need to. Now, some of you, and I know this because you sent me a message, you're like, look, how is this couple working with you? You told me that you had a $2 million minimum. They had $815,000. Well, some couples I brought on early in my career, and I still work with them. Very few. And this is actually a family friend that I'm helping out here. But more often than not, right now, today, we have a $2 million minimum, which means to work with us and our team, we don't want it to be that forever. Our goal is to decrease the minimum. But to work with us, it's a $2 million minimum. Now, we have this software tool available, and the reason I do this is so that you guys don't get mad at me, like some of you have, going, hey, Ari, you told me to go talk to this person, and they just told me what a conversion is. They just told me I need to worry about healthcare. They didn't do planning for me to help out, and I paid them $2,000. So this is not, you're not getting one-on-one guidance with me. You get videos and software access. So for a lot of you, this is sufficient, but others of you go, no, I have $2 million. I need help. I want that next level of planning. That's why we're here. And so our goal in the future is to actually decrease the minimum and be able to help way more people. I just need to bring on enough advisors that can give high quality guidance so you don't get average service. So that's something we're actively working on. That's it for today's video. Hopefully this was helpful, getting a sense as to how should I save, where should it go. But once again, if I'm going to connect all the dots for you, is for you guys, it's all about cash flows. And a summary to help you guys understand when you look at your different accounts is as you grow, this is what I would encourage all of you to do, is you're going to have a taxable account and a 401k and a traditional IRA. And for this reason, they're actually saving for nieces and nephews, so they have 529s. So based on this plan, you want to understand, well, what's my money going to grow to? And look, if their 401k keeps growing, it's going to be like 1 million, 2 million, too much money. They're going to have to take out. So they want to be strategic here about how much should I save and how much should I invest, and if I save. So the point of all of this is you want to be strategic and you don't want to have too much in any one bucket. You want to have a diversified amount. So this is what planning looks like with us. Hopefully this was helpful and gave you some things to think about regarding your own plan.